Good afternoon, everyone. Thank you for joining us today. We hope you are doing well and staying safe. My name is Maria Asher, and I'm part of the investments team that manages the Westwood Select strategy. Today, we wanted to talk about outlook for the economy and the markets. For that, we have Leah Bennett and Adrian Helford joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and the lead PM on Select Strategy. Adrian is a senior vice president and the director of multi-asset portfolios here at Westwood. He's also an expert on macroeconomics. So I have prepared some questions that I'll be asking to both Leah and Adrian. Hi, Leah and Adrian. How are you guys doing?
Well, thanks.
Doing good, thank you, Maria.
So my first question is for both of you, and I would love to hear your thoughts on the economy and the markets, and has your opinion changed over the last 1 month?
Sure, I'll start. Thanks, Maria. On the market, the U.S. stock market, it has bounced significantly from the lows in March that we saw in price, but it's still below where it was pre-COVID-19. What's higher than before is the valuation. That's the price earnings ratio, or the price you pay per dollar of company's earnings. Now, optically, that looks even more expensive than it was before the crisis, right? Well, not perfectly so. The incredible stimulus that's been handed out to investors, companies, and individuals to reduce that impact of the so-called consumption void and allow for the financial plumbing to keep functioning keeps interest rates and subsequently the rate that we discount or reduce the value of future earnings by at a low rate for a long time. This can have the impact of driving that PE ratio higher, even with lower forward earnings expectations. We also came into this crisis with a much higher individual savings rate, more so than the last crisis. Investor balance sheets were better prepared, and thus we may see continued investment in the market as a support, especially knowing that the Federal Reserve, the U.S. Central Bank, and the government, which is the U.S. Treasury, will be there to assuage additional market drops. All this means that price levels on stocks have bounced and can have room to rise further from here. On the economy, my simple model for the U.S. economy is one of a virtuous and a vicious at times cycle. We entered the longest cycle in history as of mid last year, and it was a continued virtuous cycle. That cycle is one that starts with consumer confidence, where I feel good about being able to get a job or have higher wages, and though I go buy new toys for my kids, that's consumer spending. And when consumer spending happens, then goes on forth to companies that make those toys for my kids. That's capital expenditure, where they go buy machines to make more toys as they can, and then they hire people to manage those machines and people to manage those people managing the machines. And because the demand for jobs increases, so wages increases. And as wages increase and the supply of jobs increase, once again, I feel more confident about being able to walk across the street and get a job. I buy more toys for my kids. Therein lies a virtuous cycle. With the COVID-19 consumption void, the concern is the start of a vicious cycle on that's the exact same, just the negative feedback loop. And that's what the government is hoping to break very quickly, getting confidence back to the markets and resume that consumption that is roughly 75% of our U.S. economic contribution. Over the last month, you asked how my thoughts have changed. Well, we have seen some decent earnings reports and consumption data that's giving a profile of where the spending is happening and where it's not. One interesting data metric you can see for yourself now is this Google Mobility and Apple Mobility data that shows in near real time the volume of requests for smartphone requests to go to gas stations, grocery stores, malls, retail shops, vacation destinations. And the picture is one that over the last month is showing demand that's, well, previously shrunk by 30 to 50% in many areas, meaning consuming for discretionary items is significantly impacted. It's coming back at a decent clip, and it's giving markets a hope of a faster recovery. I do remain cautious on that. It will return, that is consumption, but likely to settle at a lower base level during this period of downturn that we have in the near term. So I'm myself unlikely to go to a movie in the next couple of months, and it's that visibility that we want to see before true consumption comes back. Thanks. Leah?
Thanks, Adrian. Yeah, this has been a really interesting period, to state the obvious. Over really the last 60 days, there's kind of a few more items that I've been thinking about more seriously than I was a couple months ago. And one is I'm surprised. I think the economy is actually more resilient than what we give it credit for. And the second has really been the unintended consequences and investment opportunities that might emerge from this period. And this period being really more impactful than what I would have anticipated when we first went into it. And to kind of drill down on both these a little bit, I do think if you look at this, the period where we are today versus where we are when we went through the financial crisis, and I'm going to compare a little bit between the two periods, even though they're dramatically different for multiple reasons. One, technology has come so far that companies are actually much more adaptive and innovative than they were 10, 12 years ago, which is really encouraging. If you think about just to pick one business model, you think about cars. People are, rather than going to auto dealerships now, they're buying cars online, and dealerships are driving the cars to individuals' homes. So businesses are innovating very rapidly and are kind of adapting to the environment, which is encouraging. You also have companies that are around today that weren't around 10 or 12 years ago that are absorbing some of the furloughed and laid off individuals. Now, we don't know what permanent unemployment or semi-permanent unemployment is versus the numbers we see today because of the number of people who hopefully will get called back to work as the economy does pick up. But you do have companies like Instacart that are around now, and Instacart, I think, employed 100,000 people at the end of the year, and now they employ 500,000 people. And it is an opportunity for somebody who's unemployed to be able to be able to compensate or replace some of their income, albeit at a lower rate and without benefits. But it's not as catastrophic as it was when we went through the financial crisis. And then you have companies that are innovating, like Amazon, that are well equipped through this downturn, who are hiring people. So the resilience of the economy is something that I think is interesting and probably has been underappreciated, and it will be interesting to see how that continues to play out during the rest of the year. The other thing that I think is interesting is the unintended consequences that will come through this period. So again, if I go back to the financial crisis and I think about what we went through during that period, there were the very clear implications that occurred. So you had more people, we had to look at underwriting differently. There was too much leverage in the financial system. Lending had to change. Those were the very obvious things that happened. And you could certainly look at how to invest around those items. But the unintended consequences, as we psychologically scarred an entire generation of people that doesn't want to own things. And if you look at the impact that that's made to the economy, so that's really where the birth of shared services came from. So Uber, Airbnb, all those type of companies were born after that period, and it really was from demand from that generation that wanted to look at ownership of everything in a different way. And it's a group of individuals, for the most part, who own a lot less in housing than previous generations, and that's created a boom in multifamily housing. So I'm kind of curious, as we come through this, the obvious implications, I think, are we'll look strategically at healthcare differently than we have in the past. We're obviously going to have to look at travel differently. Sporting events will be different. Adrienne, you mentioned movies. Movies will probably be different. But what are the unintended consequences? And that's something we're talking about a lot. And how do you invest around that? And with technology today, I do think companies can innovate and very rapidly, and you'll see things starting to emerge from this, which I think will be quite interesting.
Thank you so much, Leah and Adrienne. So just to follow up on that, so between end of February to March 23rd, we saw the fastest decline in the market, and then markets recovered most of it. So how concerned are you right now about different areas within the market?
Sure, and I'd say we did see that recovery from, I mean, the S&P 500 was down over 30% on the year in short order. So while we have seen that bounce back, I don't think it's immune to the virus. That speed of the recovery is truly surprising. A few things that may be driving this are, those high cash levels that we had, the savings rates, and the money to be put to work supporting investment. That data that I mentioned leading to maybe an overestimation of the speed and the height of the recovery that investors are already starting to observe now. And last but definitely not least, if not greatest, is the central bank and the government response. So that response, and not just what we've done so far, but the signaling and the expectation now that they are standing by, ready to administer further stimulus as quickly and in as much quantity as needed, is helping drive this back. So the concerns for coming back further and faster, I'd say faster, is the most concerning. But the recovery itself is rather expected. It's just the time frame. And maybe what concerns me most right now is that the potential for a drop in longer term growth expectations. Right now, we are looking forward and saying, okay, as I said, we can see growth in the future. There is a point at which the stimulative effect of this fiscal spending and the central bank balance sheet expansion becomes more of a headwind on future liabilities, pulling down medium and longer term growth, thinking at some point we have to pay back our future liabilities. We cannot purely spend our way out and ignore future liabilities. Myself, I've been analyzing companies long enough to recognize that that's a recipe for trouble, that lots of spending in the front end financed by debt can lead to a disaster if you don't grow your way out of it or find a way to repay your debt profile. So what concerns me most really at this point is longer term growth expectations could be pulled down from the spending, because we have effectively shot first to ask questions later on bailing out the market.
And I agree with Adrian. It's been impressive to see this, the appreciation that we've seen in stocks so far. But I think it is important to look at the composition of the returns, because definitely the big indices have had major comebacks, and obviously the S&P is down, I think a little over 7% now for the year, and the Nasdaq is actually up a bit, which is fascinating. But I do think because they're market weighted indices, they kind of mask some of the weakness that you've seen elsewhere. So now you have 25% of the S&P is comprised of just 5 stocks, and they're primarily tech stocks. And they're companies that have adapted really well to this environment or were set up to benefit from this environment. So if you think about Microsoft, they're certainly benefiting from the spending that's moving towards the cloud. Think about Amazon, which we talked about earlier. They're certainly benefiting from what's happening in this environment. But if you think about if the big indices, if the composition were different and it was more diversified, we'd have a really different story. So if Caterpillar and Exxon and Boeing were bigger weights in the index, you'd see something very different as far as what the recovery has been. So again, I mentioned the S&P is down a little over 7% for the year. The unweighted return of the S&P is actually down 14%. And then if we look at small caps, Adrian was mentioning the S&P was down about 30% at its worst. Small caps were down 40%. And of course, the thought was when we were going through this period where a lot of the bankruptcies would happen is companies that don't have the bigger balance sheets and can't make it through this period. Either they're levered or they just don't have as much ability to borrow. And that would certainly be in the small caps. So I think the market was being very rational in predicting there was a lot of risk in small cap. But small caps are still down quite a bit. Small cap index, the Russell 2000, still down about 16%. And then if you look at small cap value, it's down about 25%. So I think a lot of the weakness in the general market has been masked by the big indices, but there's still possibly, if you really focus on balance sheets, because I think quality is going to be a key criteria going forward and how much debt companies have, there's still some nice opportunities, I think, in the market.
Thank you so much, Adrian and Leah. So that's very helpful. My next question is for Adrian. Adrian, you talked about the stimulus bill between Fed Reserve action and the US government. It's about $6 trillion so far. So, what do you think its long term impact will be? And do you think it will have an inflationary or deflationary impact in the longer term?
Sure, thanks. That number, just to mention it, is pretty crazy when you think about it. These are extraordinary times, and where we previously went through a financial crisis, that we had done things we'd never done before. We've now surpassed that, and we did it in record time, where previously it took us months. This was enacted in a matter of weeks. Of course, as you mentioned, the big concern right now among investors is that this could be inflationary to highly inflationary. And simplistically, inflation for consumers means prices are rising on goods and services. It reduces the forward value of your savings, and especially if you're on a fixed income earning stream. It can have the positive impact of incentivizing spending now as opposed to the future. And it can, of course, reduce the value of a company and an individual's debt load, i.e., the price of your house goes up, but the borrowing against it remains the same. And inflation, it usually requires heightened demand and spending. With such a loss of jobs, where we have seen 30 plus million jobs gone, and a forthcoming strong economic downturn, we don't anticipate a sustained demand spike in the near and medium term. In addition, consumers may be concerned around the uncertainty, as I mentioned, of the tax burden in the future, given the increasing national debt level that we'll need to find a way to pay back. Inflation is generally good for real assets, like real estate and certain industries like natural resources and mining and equipment. And those are decent to have in your portfolio, but we don't see extraordinarily high inflation. Deflation, on the other hand, is when prices are dropping. This is most often due to economic downturn, dropping demand. This is more concerning, as for one thing, it increases the debt load of companies individuals, i.e., your house price went down, yet your loan remains the same. This is always more concerning for economists and central bankers, which is one reason why, as I said, they shop first and ask questions later. They've been so strongly reactive with stimulus without the concern at this point of inflationary creation. So long-term inflation runs about 2% a year. The market is currently expecting as of today, only about 1.1% for the next 10 years a year. So while it is a decent time to have inflation protection for downside risk, that includes real assets, it is hard to see inflation running rampant in the medium term. And many people compare this to the 1970s, when inflation did run rampant. But that is the wrong playbook. That period of high inflation followed a sharp depreciation in the US dollar and two major commodity price shocks that drove up food and energy inflation. That's when we had the oil prices going significantly higher. None of those are the case today. In addition, the labor market forces at that time enabled employee compensation to quickly catch up to pass inflation, helping reinforce the underlying price pressure. That wage inflation link is much less strong now than it was in the 1970s. So long story short, the demand destruction from COVID-19, or the consumption void, is not as prevalent and not supporting prices going up. So a thought for speculation at the end of this is that we could see goods and prices rising as a result of future distancing. Think restaurants with tables further apart and flights with no middle seat, raising prices in companies that are trying to make the same profits with less customers. If this happens without wage inflation, without my wages going up, and broad economic growth, we could have that pernicious condition called stagflation. That's a risk that we consider that worsens the vicious cycle, but it's not one I currently think that we will see. It's more likely to continue to see low inflation from here, ticking along under 2% a year for the near and the medium term.
Yeah, I agree. I think it's going to be an interesting period, and to see how quickly demand destruction and for how long it continues to manifest. So again, if you think about companies coming out of this period, how they think about improving their efficiency and how they can do more with less. And as more people, I think work from home was kind of a luxury and kind of viewed as a perk for companies, and now it's being viewed just completely differently in a very short period of time. And over the long term, if companies think about more of their workforce working from home, obviously you have less demand for commercial real estate, and then you think about the implications of that. It's less people driving to the office. There's less demand for energy. There's less need for the same business clothes that you had on. So there's definitely a cycle in there that I think will be interesting to kind of monitor how scarring and how long this impact lasts. Adrian also made a comment about the deficit and about higher taxes, and I think that certainly plays out in areas conversations that we're having with clients. So I think it's not only higher income taxes, which regardless of what happens with this current election, at some point we're going to have to pay the bill for everything that we're putting into place now, and so income taxes I think have to go up at some point. But an obvious where I think there'll be a change is really with estate taxes. So if you look at a state exemption right now is 11.4 million per individual. So it's the highest we've ever had. So for a married couple, you can, without having to pay estate taxes, your estate, anything below 22.8 million passes tax-free. Before it moved up to the 11.4 per individual, it was at 5. So there's a lot of speculation that when this law sunsets at the end of 2025, then 2026 exemptions could be back to 5 million per individual, and it's 5 million index for inflation, so it'd be a little above 5 million. But it could even be lower than that. And so those are definitely conversations we're having with clients is how do you think about estate planning now in this environment while we get a chance to put things in place before estate taxes start moving up.
Thank you so much, Leah and Adrian. Very helpful. So my last question is again for both of you. As you know, and as we talked about, 2020 has definitely been an unprecedented year in so many different ways. So what keeps you up at night, and how do you think about protecting our clients' assets?
Sure. Well, just to start off, briefly, to me, it's about protecting not just client asset, it's about protecting the future investment capability. It's about appropriately positioning for that protection against those risks that we talk about here, like inflation and deflation, as well as observing that there are going to be declining values in areas that may be in secular decline or increasingly rapid decline, while capturing returns for investors for the opportunities that exist and the opportunities in sectors like areas of technology that Leah talked about. There's new economic forces, there are new consumption patterns that can change sector and industry leaders. Some of the new technologies and healthcare solutions that we talk about can deliver strong returns for investors. And we want to ensure not just that we're fully protective, but we are capturing upside. We are looking towards investors' futures as well. Then, of course, when we have low rates for a long term, in addition, the compensation for income on many of the investments does now look considerably more attractive given this paradigm. And that's likely going to remain that way for a long period of time. So, when I think about client assets and protecting their assets, it's protecting their future as well and thinking about where the opportunities lies. So I lie awake thinking about the good and the bad, I guess.
And I think that's healthy to be looking at both sides. Yeah, I do think this is an environment where, I mean, we've seen a tremendous amount of volatility from the market, and you have to be nimble, I think, in order to both protect and take advantage of where trends are starting to emerge and where there's opportunities. This isn't a buy and hold type of environment, and you can really look at any sector. You look at what's happened with energy, for example. You saw just massive value destruction in the first through mid-March, and then you've seen a huge rally in energy in April. I mean, it's exceptionally volatile. So I think being nimble is is very important. Again, both protecting and for appreciation. And then I think the big theme that's going to remain through the rest of the year is quality of portfolios. So when we're looking at companies, we definitely look at the quality of their balance sheets, looking for companies that don't have a lot of debt, and hopefully their cash flow is strong and resilient. Because I do think you're going to have kind of a have and have not with companies that are going to thrive in this environment, and those that aren't going to make it. Anybody who had a decent amount of leverage coming into this period, you've certainly seen some bankruptcies, and anyone who has a lot of fixed costs to maintain during this environment with cash flows declining are really going to be squeezed. So I think quality is something that's going to continue to be important. And then I think monitoring the credit markets is something that always keeps me up at night. Thankfully, the credit markets have improved dramatically with some of the actions the government has taken. But watching the health of the economy is really the ability to borrow, and that's something I think that we're all focused on as well.
Thank you so much, Leah and Adrian, for your insights. I think just to summarize, for me, the two key takeaways from our conversation today were, number one, while the overall market has run up more than 30% since hitting bottom on March 23rd, there are certain areas where the valuations remain attractive, and also that some of the larger companies are basically masking the weakness in other areas. And number two, we do not believe that the stimulus bill will result in an inflationary impact. With that, I'll bring an end to our call today. Thank you everyone once again for joining us. Please feel free to reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Goodbye.
Thank you. Goodbye.